I think, well, we've been in it a while now, and the equity markets are behaving reasonably rationally. There's rotation between sectors, opportunities are emerging, value is there for those that want to look for it. So that's all great. This is the recovery in process. The fixation on inflation is there and is a concern, the number one concern at the moment. But it could be simply that it's making the wrong connection. Bond yields are rising for different reasons to worries about inflation. And when you look beneath the surface at inflation, what we can see is that it's very volatile at the moment. The constituents are moving all over the place. And that's to do with supply and demand. And that has been a big issue as we recover from the pandemic lockdown and restrictions. It could just be that we're seeing an oversupply of bonds. Worse things have happened. I like to think that we're in the middle of a recovery and bond markets are reacting to that in a relatively sensible way, in that yields are rising because we can see better things to do with our money.
Talking of better things to do with our money, David, very interesting. The Bank of America Merrill Lynch Fund Manager Survey suggests that we've now seen the biggest drop in investor exposure to tech in 15 years. OK, it's still an overweight, but ultimately tech has been cut to the lowest holding since January of 2009. Would you agree with that approach to owning tech and growth at this point?
Well, I'm a great fan of owning companies that are making profits and higher profits and have a plan to do so. It has got overcooked in certain parts of the sector. I just don't think it's a sell on anything other than a very short-term view. But again, if we can rotate into companies that have had a really bad year, anniversary of working remotely, lockdowns coming along this week, then why not do that? But I just think that's a short-term tactical trade. There are some great companies out there, and the technology sector remains the driver of change in the global economy.
And yet there does seem to be this consensus view that's coming through at the moment that you've got to increase your cyclical exposure, you've got to own industrials, banks, discretionary and EM relative. Any reason to think that that consensus view might be wrong or might be over-egged?
I think the consensus is reasonable at the moment. I think it's a matter of balance. That's what it is, Jeff. I mean, don't go too far one direction or the other. It's very easy to boast about good performance this year by owning the stocks that were a complete disaster last year and vice versa. I think incrementally we are moving, as I said, towards a recovery. Business as usual is becoming more of the top of the agenda than it was a few months back. And there will be this value argument, and there is good value in certain sectors that were particularly badly hurt last year. You look at companies in the tech sector, let's look at IBM, where earnings have grown 3% only. The PE multiple is 10. That doesn't strike me as good value even at that stage. But a number of others are just delivering 25, 30% earnings growth. And if interest rates stay low, to our previous discussion, then that's good value.
There are still COVID disasters going on around the world, from Brazil to worrying increases in figures in places such as Italy as well. Have we got a little bit ahead of ourselves in the speed with which the global economy can recover? There are certain places where things are going very well. Israel, dare I say it for once, United Kingdom as well. But have we over-egged the speed of the recovery in the second half of this year?
Well, we'll see. I can't comment on it, on whether or not that is the case. I think we'll have to watch the numbers, the developments. But what I would say is that the world has restructured itself in the last 12 months. The manufacturing sector is continuing to perform really well. What we're seeing at the moment is a little bit of a catch up in the leisure hospitality sector in anticipation of the reopening. That could go wrong. I mean, to be perfectly blunt, we travel hopefully on that side, and I wouldn't be surprised to see there being further setbacks in the months ahead, because, as you say, infection rates are rising. in certain countries. Vaccine rollouts are slow in the EU. This is a problem to come if this doesn't get sorted out and we get back into the autumn with infection rates rising again, then you could well see a rotation away. So I just think, and this is not being boring about it, but it is a matter of balance at the moment. Don't be blind to the change and opportunity, but equally, keep an eye on the facts rather than just the optimism.